Hello traders, welcome to our weekly analysis for October 30th to November 4th. So this is the last week of October and first week of November. So of course, first thing that should come to your mind is that beginning of every month we will have the non-farm payroll, which is usually one of the most important catalysts. But of course, as I mentioned, the key to know which catalyst is tradable or is even important is really to looking at the catalyst from the perspective of the central banks. So first thing first is that if you want to know what had happened last week, you can go to our last Friday weekend recap, which I have basically have done a recap for the week already. So if you want to know what had happened last week, you can feel free to take a look at that video. You can see that at my website or my YouTube channel. Now for this week, as I mentioned in the previous video, the most important event will be the Bank of England, which coming out on Thursday. But let's take into our calendar to see exactly what other things are coming. So of course, Monday and over the weekend, we don't really have much going on today. Now today, the most important event have already passed, which is the core PCE. Now let me refresh it to see what's the number. So as you can see, core PCE from US is 0.1%, personal spending is slightly better, and personal income is also 0.4%, which is all better than the previous. So it's not really a big shocker. Although it's positive, it's not really going to move US dollar too much. Now, if you want to know what's going to move US dollar for this week, it's really not going to come from the fundamental data. Because fundamentally, especially last week when the advanced GDP hit 3%, which is very positive for the US dollar. So right now, as we mentioned in a previous videos, it's not a surprise that US is very strong fundamentally right now. So what market really want to see is two things. First is they want to see the inflation picked up, because if the inflation is really the only lagging indicators, basically, aside from GDP, aside from employment, inflation is really the only thing that Federal Reserve hasn't been able to raise interest rate as fast as they want. So that's the first element, the real important fundamental data for US. The second thing is actually the geopolitics, especially the Congress and the White House. So you have to understand this week there are possible three things to shake US dollar. First is Donald Trump is most likely going to announce the Federal Reserve chair for next year. Now we know last week, there was rumor that Janet Yellen was still in the consideration, but toward the end of the week, it turned out that she is out of the consideration. So right now, it's really come down to Powell and Tyler. But doesn't matter which candidate Donald Trump select at the end, they are all perceived as more hawkish than Janet Yellen. Now, of course, Tyler will be a more hawkish selection, but either way, market is quite optimistic. As long as he really pick Powell or Tyler. But who knows? He might really just give Yellen another terms. We never know. So that's the first thing that might shake US dollar. Second thing is the tax cut plan. Right now, it seems to have a lot of opposition, and many of you, if you follow the US politics, you know that that's pretty much the whole scenario in 2017, is that although the Republican Party had controlled the Congress, but Trump had faced a lot of opposition even within his own party. So, this is going to be very important, not only for the tax cut plan, but again, as I mentioned, if the plan can pass, it shows that Trump is still in control. Republicans are still in unison. That means in the future, again, this is just the first year. I know it seems like a long time already. This is just his first year. He still has 3 years to go. So that means in the future, he will have more control over a lot of pro-business policy. Now, the third thing that might come out this week is the special investigation into the Russian probe into the election. So many of you know, in the beginning of the 2017, this was the biggest event, and it seems that we haven't heard anything on that. And it turned out that's because the special investigation is really, secretly under the table doing a lot of investigation. It turns out that November it's going to be the end of this case, and that means we're really going to see who is going to be guilty or who is going to basically be accused. And that's going to shake the market, especially if the person who is going to be on the trial are the top layer within the Trump's circle. So that's something that might really pressure US dollar, because if you see DAX right now, it's really at 95 last week, although we retrace a little bit, but it is still a really huge shoots up last week. So these few things are really I actually think the geopolitical events has more volume in terms of shaking the US dollar and overall market. So please watch out for that. That's really going to be the biggest risk for any US dollar buyers. That's including myself, because I'm really looking to buy US dollar as well. So Monday, the end of the night, and Tuesday morning, Asian session, we are going to see BOJ monetary policy. But although it's an important event, it's really probably going to be a non-event, because remember, Prime Minister Abe just won a big victory in the parliament, and right now it seems there's nothing going to be changed basically for the BOJ and their QQE program. So we're not really going to see too much change, and this is not really going to move the market. And then we're going to see the GDP data. Now this will be tradable if you have something that is very positive or very negative. Now right now, coming to the market, nothing had changed from my previous video. So Canadian dollar is still a very fundamentally strong currency. So right here, so I personally think Canadian dollar is still fundamentally strong, but sentimentally it's weak. It's weak because last week we have the Bank of Canada, and the statement, although it's not really dovish, to be honest, but again, it's not how I think or how you think about the statement. It's how the market perceived. So the market think the statement is very dovish. Now the reason it's, again, in a currency market, everything is about comparison. So it's not because Bank of Canada become very dovish. It's because they became less hawkish. So in the previous two events, not only they came out and hike interest rate, it was actually a hawkish hike. So because of that, market, of course, they are used to this kind of pattern. They want to see more hawkish momentum coming out from BOC. And unfortunately, that was not the case last week. We saw Bank of Canada became quite conservative. And basically right now, they are not going to do anything about interest rate. They are going to be data dependent. So unless the inflation, employment, and GDP continue to go up, then we have a probability for them to hike further. Otherwise, they are not going to do anything. That doesn't mean they're going to cut, right? That means the economy is still doing very well, but unless that, basically we have to see another month or 3 months pass and consecutive of positive fundamental data before they can justify another rate hike. Because of that, right now the fundamental data had become very important for Canada, especially the big three, which is GDP, employment, and inflation. And that's why this is a tradable event, but you do need to see a sort of surprise to drive the market. So if you are a day trader and you're looking to have a short-term momentum, this is actually going to be a good event if we have something that is outside a deviation. So if you have something that's, again, positive than 0.1% or negative than 0%, then that's all something that's tradable. Then don't forget, you also have Polo's speak. Now, for central banker to speak again, it's not really predictable, so we never know what they're gonna speak. But if you can, of course, just be careful. If you are in Canadian dollar trade, be careful for the events. The end of the market, we are going to have the New Zealand employment data. Now, New Zealand, as many of you know, is one of the weakest currency at the moment. And the interesting thing is that, we always say, okay, a certain currency is sentimentally weak or is sentimentally strong. But the key is to not only understand if it's weak or strong. I think the hardest thing is for a trader is to understand how long and how lasting that sentiment is going to be. For example, Canadian dollar had a very weak sentiment because last week the Bank of Canada. But I personally don't think that sentiment is going to last too long, unless this week if we see a very negative GDP, if we see a very negative employment data from Canada, then yes, the sentiment will continue. But on the contrary, if this week GDP and employment out of Canada are both very positive, then the sentiment will change to a positive. That's not the case for New Zealand. So for the employment data, to be honest, I'm not even going to trade or even consider it's important. Why? Because the negative sentiment for New Zealand is a top-down sentiment. That means that negativity comes directly from a major component. First of all, it's the central bank of RBNZ. RBNZ right now is firmly hold on the interest rate, so they are not going to raise interest rate at all. That means that whoever wants to buy New Zealand dollar because they want to buy into the future, it's not going to happen. So unless the central bank change, otherwise this is going to be one of the negative component. Now, second component is the government. Again, the government downgraded the forecast previously, and that's basically the fact. So unless the New Zealand government comes out and suddenly upgrade that forecast or remove the downgrade, unless that happens, otherwise it's a very negative component. Now, the third biggest component is the Liberal Party, which is right now the government of New Zealand. They published that policy last week. The mandate basically was perceived very unfriendly and very anti-business. Basically, not only they are anti-foreigners and foreign investment, which is not good for the economy, they are thinking of to change RBNZ's future policy. Now, whether or not that change is good or bad, it doesn't matter. Right now, what the market is worried about is that central bank should have solvency. Central bank should be independent from the government. So if the government decide to have a hand into controlling the central bank, it's not really a free market. So the market or the capitalist market does not like this kind of change. So all these things are a very negative sentiment for New Zealand, and they are all coming from the top. So unless this change, otherwise all this fundamental data, it's really not gonna change the negative sentiment of New Zealand. And we have already saw that previously the CPI coming out from New Zealand 2 weeks ago was actually very positive, but that hardly moved New Zealand dollar at all. So for that, those kind of events, we now think, and I think this employment change, although you can see 0.8% was much better than negative 0.2, really not gonna move New Zealand dollar too much. It's going to create a short-term momentum, but I personally don't like to trade this kind of thing because it just completely go against the fundamental and the sentimental. And what about if you have something negative? Well, if you have something negative, you could sell New Zealand, of course. But the thing is that New Zealand dollar is already at a very low area. So again, it really depends on your own technical strategy. But basically, it's not going to create too much momentum that worthwhile for me to trade, right? So that's why I'm not really looking to trade this kind of catalyst. Then during the Asian session, you're going to have the Chinese manufacturing data. Now, speaking of Chinese, what happened to Aussie right now? So Aussie, again, right now, it's a little bit negative. Last week, the CPI came out very negative. Now, not only the CPI was lower than expectation right here. People might say, oh, but it's better than the previous. But you have to understand the RBA is looking at the trimming CPI. And that means this will be the go-to inflation data for them. 0.4%. Again, if we expand this one, you see 0.4. Yes, it's not particularly negative. But if you're looking at the whole data, you realize it's very flat. It's just very flat for the inflation. That means there's really no chance for RBA to raise interest rate anytime soon. But that still does not mean they're very negative. Why? Because as I mentioned, the commodity market continue to support Australian dollar. So as long as the commodity market continue to support it, and the other component will be the Chinese economy, which again right now is still very well, doing very well in comparison to other major countries. So that's why we are not really looking to sell Aussie or buy Aussie. Basically, it's not a tradable currency for me, just because I don't have a clear momentum. So on Wednesday, we are going to also see the ADP non-farm employment change. Now, this is more like a preview for non-farm payroll. Usually, this is tradable, but because right now, non-farm payroll is not even that important, as I mentioned. Right now, if you have been trading non-farm payroll, you know that this employment change, yes, it's going to create maybe a short-term momentum. It's not going to last anything meaningful. The reason is because the job data had been very well for the US. So nothing is going to really push US dollar upside or downside unless you have something that's really negative. Now, people might say, oh, what about last time you have a minus 33? Well, you have to looking at things in the context, right? When you're looking at fundamental data, you don't just look at this data. You want to see the news as well. So when you see this kind of number, you say, okay, what happened? How come all of a sudden we have all positive number and one negative number? Well, that's because the hurricane. So we have the hurricane during the summer season in September. So that's why you have this large drop. Now, if you take into less consideration, of course, market and the market participant are not going to be too surprised. So that's why this time the expectation is, we're going to be back to normal. Again, right now, what's going to drive US dollar fundamentally is the inflation. So if you want to trade it, you have to look at average earning. Now, this time, expectation is 0.2%. Not particularly good or bad. I'll say it's just flat. So again, I don't really think non-farm payroll is gonna create too much lasting effect. It's really depend on the geopolitical effect this week. That's really what's gonna drive the market. So we'll see what happens as the week unfolds. Then a non-farm payroll will just be the last push, either upside or downside for the US dollar. So Wednesday, another important event. Let's see. So FOMC, again, it's not really an event. Why? Because right now, the market is looking out for the December rate hike. So really 100% that the rate is going to be unchanged. Now, the statement itself, the only thing that's worthwhile to see is how the Fed members is going to address the inflation. Do they think the inflation had picked up, or do they still think it's low and it's not transitory? So that's something that's, it's going to drive the US dollar. But most likely, it's really not going to be too much effect, especially, again, like I mentioned, Janet Yellen is most likely going to be out, next year. So, her volume or a statement, it's going to be less and less important for the market, to digest, because it's really about who is the future chair. And let's keep going. Thursday, again, the biggest event will be Bank of England. Now, right now, the market has pricing something like above 80% of probability for a rate hike. So that means if you see a rate hike, don't jump in because it had already been expected, right? Again, like I said, you might have a buy rumor sell fact effect. Now, in fact, if you take a look at Pompeo from last video, last Friday we're still right here again, and look at what happened during this time. We actually this already happening. You see this arrow, this what I draw last week. You see, it's already happening. It's already happening. You see this? So again, it's a very typical buying rumor. Now, what I don't know is, are we going to have a sell fact effect? Because what's gonna happen is really depend on Bank of England's statement and a press conference. Are they going to be hawkish or dovish? Now, honestly, I don't know, because it had happened. Like Euro last week, you have a dovish delivery, so you see a euro dollar basically drop right after the ECB event. But don't forget, previously we have a Bank of Canada. A lot of people still trying to buy rumor sell fact, but Bank of Canada actually came out and be a hawkish hike. So we don't know whether Bank of England gonna be a hawkish hike or dovish hike. And I think both argument makes sense. For the hawkish hike, people think that the whole purpose they hike interest rate is to control the inflation. That means if they give a dovish hike, the currency is going to drop. So it's not going to do too much effect for the inflation, right? Because the inflation is so high in the first place is because the currency dropped significantly after Brexit. So if they hike but they become dovish, then there's no purpose. It's like shooting in your own foot. But the argument is that what kind of evidence they have for a hawkish hike. Because if they come out and say, okay, we're gonna hike and we're very hawkish for the economy, people are gonna question, are you? What about the Brexit? What about the fact that retail drops? What about the fact that GDP had missed the previous expectation? What about the job data had missed previous expectation? What about all these things? Now, you have to understand, it's not only about how central bank deliver. Market has to buy it, right? So this is really a two-way tango. So central bank can come out and say, oh, we're very hawkish. But if they don't have enough evidence, then the market is simply not going to buy it. They are not going to believe it, basically. So that's why it's hard to know what's going to happen. So for me, I wouldn't put my bet on what's going to happen, right? I put my bet on what's going to happen into the events. So I have a high probability that what's going to happen into the events is a buying into British pound. But what's going to happen after or at the events, I don't really know. So if I don't know, and then I'd rather not putting a bet on it. So that's Thursday. You have to really, again, this is going to be a very volatile event. Really, the biggest event will be this one. And then, of course, you have Aussie retail. Now, this is, you can play around this one. I personally, again, not really looking to trade this kind of events, because I do like to trade something that has a large volatility and momentum. So it's not really an event I'll trade. Then, of course, comes to Friday. You have Canadian dollar employment data and the employment data of US. Again, I think CAD data will be tradable, but we have to see how the Canadian dollar act during the week. So it's really depending on how the GDP unfold, how the oil market, crude oil inventory, then we can see which direction the Canadian dollar is most likely to go. Non-farm payroll, again, not really tradable for me as a day trade, but I will still leaning toward buying US dollar. Again, the biggest risk for US dollar this week will be coming from geopolitical momentums. That's pretty much it. Now, I am adding on a new feature for the email subscribers. So every week, if you're watching this video now, basically you are subscribed. So if you are subscribed, then you will receive a trade call. So what I'm trying to do right now is every week I will give you a swing trade call. Now, I use swing trade because, again, most people have a full-time job, and I think, swing trade, personally for me, it has a higher winning rate and has a better risk-reward ratio. Now, of course, it's not going to happen every week, right? I'm not going to force trade. So unless we have a good event, a good reason to enter, fundamentally, sentimentally, and have a good technical pattern to follow. So the reason I'm doing this is because I think it will be a great chance for you to actually practice and learn. Now, if you want to follow, it's up to you. I don't want to tell you to follow or not follow because it's your own risk. But I'll tell you exactly, I'll pick one trade per week that is very, very high quality. And then we will see how that trade unfolds. So once the trade is out, then I will basically make another video, a very short 5 minutes video, just to explain the whole logic of getting in and getting out of that trade. So you get to learn the exactly thought pattern of how we take a swing trade, a very high quality swing trade. Why do we enter? How do we manage it? And why do we get out? So I think that will be a very valuable lesson. It's going to be free for current email subscribers. Now, if you're watching this video and you are not an email subscribers, you can do so. Just go to my website. Again, it's just a free service just for you to learn. And just basically, you can just register here. Now, I will have a new tab here called a trade call video. So that's just for the future video for that. So that's something interesting to see. And other than that, that's pretty much it. Again, Monday is very quiet. Tuesday, tomorrow, again, not too much thing happening. So we'll see what happens this week. Again, of course, you probably know what events I'm really looking at, which will be a Bank of England event. But I will send you that trade call if you are in my email subscribers. And be careful how much percentage you want to risk. It's really up to you. Generally speaking, this kind of trade call, I personally will risk 1%, which is the maximum percentage for me to per trade. So you can, if your maximum number is 2%, that's fine. If your maximum number is 0.5, that's also fine. It really depends on your own risk appetite. Okay, but in terms of the market, our weekly game plan, that's what I'm looking at right now. So again, I understand this buying rumor has already started, so it's going to be very interesting to see how it going to react on Thursday. Okay, now thanks for watching. If you have any question, again, feel free to let me know. Otherwise, I will see you again on Friday. Thanks for watching. Bye bye.